Namaste, welcome to Arthaniti. Today I want to explain some concepts that we usually hear and read about when we are analyzing a mutual fund. Now, while taking a decision as to whether a mutual fund is suitable for investing, there are certain parameters which are normally shown on various websites like say ET Money or moneycontrol.com, or even when you see shows on televisions on CNBC, NDTV Profit, such terms are normally used and it becomes very difficult to understand what these terms really mean. Well, today I'm going to simplify those terms for you so that it becomes easier for you to take decisions while investing in a mutual fund. Now, in the context of mutual funds, there are four concepts, four ratios which are used to analyze the performance of a mutual fund. The first one that we normally hear is a term called alpha. Now, alpha, what is alpha? What does this ratio mean? Well, in simple terms, alpha means the performance of a mutual fund in relation, in comparison to the benchmark index. Now, each mutual fund has a benchmark against which the performance of the fund is compared. Like equity funds have a benchmark, say, of Nifty or BSE Sensex, correct? I will show you an example of benchmark. It is normally mentioned in all scheme documents of mutual funds. Here I am taking an example of an ICICI Prudential Mutual Fund, the multi-cap fund. Now, if you see this area, it says that the fund is benchmark against Nifty 50 Index TRI. Additional benchmark Nifty 500 multi-cap with a 50, 25 and 25 ratio between the various companies where it is invested in. Correct? So this becomes a benchmark against which the fund's performance is checked. Now, what does alpha show? Well, alpha shows how the mutual fund has performed in comparison to this benchmark. If the alpha is positive, well, it is a good sign. It indicates that the fund has performed better than the underlying benchmark. If the alpha is negative, you know the answer. The fund has underperformed in comparison to its benchmark. Well, what does this show? How well the fund has managed. It shows the performance of the fund manager. So you can examine how the funds are being managed in a particular mutual fund by looking at the alpha numbers. A positive alpha is a good sign where the fund has performed better than the underlying benchmark, while a negative alpha shows underperformance of the mutual fund in comparison to its benchmark. The second term that I want to tell you about is beta. Well, beta measures the volatility of a mutual fund, again in comparison to this benchmark, the underlying benchmark against which its performance is compared. So, well, alpha measures the performance of the fund, beta measures the volatility, the risk factor in a mutual fund. When the beta is 1, it means the fund has the same volatility in comparison to the benchmark against which it is getting compared. So, a 1 beta will have equal weightage of risk when it comes to the benchmark as well as the fund. Correct? A beta which is less than 1. What does this mean? Less than 1 beta is a good sign. It means the fund is less volatile as compared to the underlying benchmark. And a beta which is higher than 1 means the fund which is more volatile than the underlying benchmark. Again, I want to show you on the website how beta is shown and what does it actually mean. Well, here I have taken the example of the same fund, ICICI Prudential Multi-Cap Fund. Now, if you see risk ratios, these are given for all the funds. These are typically given on websites, financial websites like ET Money, Money Control, Value Research, so on and so forth. Now, if you see beta here, it says 0.88 versus 0.82 of the category average. Now see, what this means is the category average, in the sense the other mutual funds in this category have a 0.88 I'm sorry, 0.82 beta, but this fund is slightly more riskier than those other mutual funds in the same category. This has a 0.88 beta, but again this beta is lower than 1, which means that as compared to the underlying benchmark, the volatility level of this fund is lower. Understand? Did you understand? Yes, quite easy. Now, the third factor that I want to tell you, that is normally spoken about and it is quite confusing to understand, is CAGR, compounding annual rate of growth. CAGR, growth rate. I'm sorry, compounding annual growth rate. Now, what does this mean? This means the annualized average returns of a fund for the duration of the fund. Now, say suppose a fund was launched 5 years back, and the 10,000 rupees that you would have invested in the fund 5 years back, say today stand at 14,000 rupees. Now the 15,000, to give you a simpler example. So this does not mean that the value of your fund has increased by 1,000 every year for the previous 5 years. Okay, why? Because say in 1 year the fund must have increased, say the valuation of the fund must have increased at a higher pace as compared to some years where the fund must have underperformed a bit. Correct? But when we say that 10,000 rupees which was invested 5 years back today stand at 15,000 rupees, we calculate, when we talk about the CAGR, we calculate the average annual return, not taking into considerations the year where the returns were higher and the years where the returns were lower. This gives you an average return over the period of the investment. So say the calculation comes to around 9%. This is just an example. What this means is, on an average for the previous 5 years, the fund has given a return or increased in valuation at the rate of 9% to reach at 15,000 after 5 years. Do you understand? So CAGR gives you a indicative rate at which the fund is annually growing. It is an average rate. It gives you the performance. It is basically a performance indicator of how a mutual fund has performed since its inception. If you check the CAGR of ICICI Prudential Multi-Cap Fund, an example which I have used throughout this video, if you see the age of the fund, it is 28 years and 3 months. The fund was launched in 1994. The CAGR, in the sense, over the period of the last 28 years, the fund has given average annual returns of 14.54%. Phenomenal rate, isn't it? What do we expect? Our investments to beat inflation. Now this has been achieved in this particular mutual fund when you see the CAGR. So in some of these 28 years, the return would have been higher than this average, say 16-18%, while in some of these 28 years, the returns would have been lower than this average of 14.54%. So on an average over the period of last 28 years, this fund has given a return of 14.54%. So these were the three concepts that I wanted to explain about analyzing a mutual fund, and I will tell you about the other ratios as well, which were shown on that particular web page that I showed you about risk ratios. Correct? I will explain you those in another video, but we go step by step, correct? So alpha, beta and CAGR. I hope you have understood what these means, and next time you hear these terms used, say in television news or when you read about reports, you easily know that. Just to summarize, alpha measures the performance of an investment in comparison to its benchmark. Positive alpha is a good sign. Beta measures the volatility of an investment in comparison to its benchmark. Beta, which is lower than 1, is a good sign, and CAGR is the average annualized return that the investment has given for the period of the investment. Correct? So I hope this video has made these three concepts clearer, simpler to understand. If you have any doubts, please feel free to comment below the video and I will be happy to help you. Please subscribe to my channels for more such videos, and in my quest to help you and me understand financial terminologies better and make good investment decisions. Until next time, see you then.